All right, let's jump right into W.R. Berkley's third quarter earnings. Ticker's WRB, by the way. We've got a huge revenue beat to talk about, but the market's reaction was kind of meh. So we're going to dig into why that is and what it might mean for the stock going forward. Okay, so here's the game plan. We'll kick things off with the big numbers, then get into what the company calls its two-engine story. After that, we'll tackle that weird disconnect between how confident management sounds and how the stock actually traded. And we'll wrap it all up with our own prediction for the next call. You gotta love this quote from the CEO, Rob Berkley. He's basically saying the rest of the industry is a hot mess, constantly shooting itself in the foot. And he's positioning W.R. Berkley as the disciplined, smart player in the room. This isn't just some throwaway line, folks. It's really the core of their whole philosophy. So, with that kind of confidence as our backdrop, let's get right to the numbers and see if the performance really backs up the talk. All right, let's look at the numbers. The official accounting number, GAAP EPS, came in at $1.28. That's a solid beat over the 110 consensus. Now, operational EPS, which is what analysts really zero in on, was right on the money. But here's the real story. Look at that revenue. $3.77 billion. That's over $500 million more than Wall Street was looking for. Huge. And that massive revenue number, it translates to almost 11% growth compared to last year. Now, you have to remember, for a big established insurance company, hitting double-digit growth is, well, it's a really big deal. It tells you they're taking market share and they've got some serious pricing power. So what's driving all this? Well, management loves to talk about their two-engine story. It's this 1-2 punch of smart underwriting and smart investing. Let's see how those engines are firing. This really shows you how it works. Engine number one is their bread and butter, the insurance business, and it is humming along. That combined ratio of 88.4%, that's just fantastic. Think of it this way. For every dollar they bring in, they're only paying out about 88 cents. The rest is pure underwriting profit. And while that's happening, engine number two, their investment portfolio, is just churning out cash, adding another $351 million. So how are they so good at underwriting? Well, they're surgical. They don't try to insure everything for everyone. No, they go after these niche, specialty markets, often focusing on smaller accounts that the big guys might overlook. And that focus gives them power, the power to raise rates by an average of 7.6% this quarter. Add in the fact that catastrophe losses were way down, and you can see how that discipline flows straight to the bottom line. And on the investment side, management gave us this little golden nugget. New money rate exceeds book yield. It sounds a bit jargony, but what it means is super simple and super powerful. Imagine you have a bunch of old savings bonds paying you, say, 1%. As they mature, you're taking that cash and buying new ones that pay 5%. It's like a built-in automatic profit booster. It's a compounding machine that's just getting started. Okay, so amazing results, a killer strategy, and a clear path for more growth. That should mean the stock is soaring, right? Well, not exactly. Let's dig into this strange disconnect between the great news and the market's reaction. I mean, listen to how the CEO closed the call. The table is set for a very strong 2026. You can't get much more bullish than that. This isn't just cautious optimism. This is a full-throated declaration of confidence. So management is practically doing a victory lap on the call, right? And the market's reaction? A collective yawn. The stock basically went nowhere. What does that tell you? It tells you expectations were already sky high. Investors were pricing this thing for perfection, and a great quarter just wasn't enough to impress them. Which leads us to the big question, the real puzzle we have to solve here. Why the disconnect? And to really get it, you can't just look at this one quarter. You have to zoom out and look at how the stock has been performing leading up to this report. Context, as they say, is everything. And this chart, this is why expectations were so high. Just look at this. Over the past year, WRB is up over 32%. That's not just beating the S&P 500, it's almost doubling it. And against other insurance stocks, it's not even a contest. The stock has been an absolute monster, so you can see why the bar was set incredibly high coming into this quarter. So let's tie all this together. We've got incredible performance, but also incredibly high expectations. What does that mean for what's next? Let's get to our prediction. So given this tug of war between amazing execution and massive expectations, we're rating the stock market perform. Basically, we think it'll probably track along with the broader market from here. It's just tough to see how it can keep up that massive outperformance.
So this all brings us to our final takeaway, our, let's call it, an outrageous but plausible prediction. The idea is to bet against a big move on the next earnings report. Here's the logic. The options market is pricing in a 5% swing, right? But if you look back, the stock just doesn't move that much. You've got this floor underneath it because the company is so well run that 21% ROE is a great cushion. But you've also got the ceiling above it because expectations are already so high. The stock is kind of stuck, which means that 5% implied move, it just seems too rich.
It's a really fascinating situation for a company that is absolutely best in class. We'll be watching it closely. And, as always, our standard reminder, this is not financial advice.